In November 2019, Tesla unveiled the Cybertruck to massive fanfare at its design studio in Hawthorne, California. Within 72 hours, the company claimed over 150,000 pre-orders. Within a week, that number had grown to 250,000. By some estimates, reservations eventually topped 1 million units.
Demand is off the charts. We have over 1 million people who have reserved the car.
Wall Street took immediate notice. Tesla's stock climbed nearly 6% in the days following the announcement on expectations of a new revenue stream that could generate billions in annual sales. The financial implications seemed enormous. Tesla was entering the $80 billion pickup truck market, America's most profitable automotive segment, with a product that promised to revolutionize the industry. Analysts began revising their Tesla price targets upward, factoring in potential Cybertruck revenues of $20 billion annually. Fast forward to 2025, and the numbers tell a dramatically different story.
The Tesla Cybertruck. In a country where pickup trucks are half of the top 10 selling vehicles, making an electric one seemed like a no-brainer. At the time the pickup debuted, Tesla was already making the world's best-selling EV.
To solve sustainable energy, we have to have a pickup truck.
The truck's design certainly provoked a range of opinions. Some loving it, others...
I thought it was a joke.
Tesla delivered fewer than 40,000 Cybertrucks produced in 2024, with just 4,300 units sold in the second quarter of 2025. To put this in perspective, Ford sells more F-150 pickups in a single week than Tesla sells Cybertrucks in an entire quarter. Today, we're examining what went wrong with one of the most anticipated product launches in automotive history, and what it reveals about the dangers of hype-driven investing, the complexity of market penetration, and the critical importance of understanding consumer psychology in modern markets. To understand the magnitude of Tesla's Cybertruck miscalculation,
Tesla has a tendency to drastically overpromise, and it's starting to catch up with the company.
we need to examine the original business proposition that generated such intense investor and consumer interest. Tesla positioned the Cybertruck as a direct assault on the pickup truck market, which represents roughly 20% of all vehicle sales in the United States. This isn't just a large market. It's the most profitable segment in automotive. Traditional pickup trucks generate profit margins of 15 to 20% compared to 5 to 10% for sedans and compact cars. The company's initial value proposition was compelling from a financial standpoint. With a promised starting price of $39,900, Tesla aimed to undercut premium gas-powered trucks while offering superior performance metrics. The base model promised 205 miles of range, 0 to 60 acceleration in 6.5 seconds, and the ability to tow 7,500 pounds. These specifications would have positioned it competitively against trucks costing $45,000 to $55,000. More importantly, Tesla projected annual sales volumes of 250,000 units within a few years of launch. At the original pricing structure, this would have generated approximately $15 to $20 billion in annual revenue, representing a 25 to 30% increase to Tesla's total revenues at the time. The business model looked even more attractive when considering Tesla's vertical integration strategy. Unlike traditional automakers who rely heavily on supplier networks, Tesla manufactures many components in-house, theoretically allowing for higher profit margins. The company estimated gross margins of 20 to 25% on Cybertruck sales, significantly higher than industry averages. Investment banks and equity analysts embraced this narrative. Morgan Stanley raised its Tesla price target, citing the Cybertruck as a game-changing product that could unlock significant value in the commercial vehicle market. Goldman Sachs published research suggesting the Cybertruck could capture 10 to 15% of the electric truck market by 2027. But this optimistic financial modeling was built on several critical assumptions that would prove incorrect. The gap between Tesla's projections and reality can be traced to 5 fundamental execution failures, each with significant financial implications. Factor 1, pricing strategy collapse. The most damaging failure was Tesla's inability to deliver on its pricing promises. By the time production began in late 2023, that $39,900 entry price had vanished entirely. The base model, now called the Cybertruck AWD, carries an $82,235 price tag. The high-performance Cyberbeast variant exceeds $100,000. This pricing shift fundamentally altered the target market and business case. At $82,000, the Cybertruck competes directly with luxury trucks like the Ford F-150 Raptor and GMC Sierra Denali, not mainstream work trucks. This pricing move effectively reduced the addressable market by approximately 70%, as it eliminated most commercial and fleet buyers who represent the core of pickup truck sales. The financial impact extends beyond unit sales. Higher prices mean lower volumes, which reduces manufacturing efficiency and increases per unit costs. Tesla's fixed costs for Cybertruck development, estimated at $5 to $7 billion, must now be amortized across a much smaller sales base, significantly impacting profitability. Factor 2, design-driven market limitations. The Cybertruck's radical design, while generating significant media attention and social media buzz, created substantial practical barriers to mass adoption. The vehicle's dimensions, 231.7 inches long and 79.8 inches wide, make it incompatible with approximately 40% of residential garages in major metropolitan areas. More critically, from a business perspective, the design doesn't comply with pedestrian safety regulations in key international markets, including the European Union and several Asian countries. This regulatory incompatibility eliminates roughly 60% of the global pickup truck market from Tesla's addressable opportunity. The angular stainless steel construction, while visually distinctive, also creates manufacturing challenges that increase production costs. Traditional automotive stamping techniques don't work with Tesla's chosen materials and design approach, requiring custom manufacturing processes that are both expensive and difficult to scale. Industry analysis suggests these design choices add approximately $8,000 to $12,000 to manufacturing costs compared to conventional truck construction, further pressuring profit margins. Factor 3, quality control crisis. Tesla's reputation for quality issues, which had improved significantly with the Model 3 and Model Y, deteriorated sharply with early Cybertruck deliveries. Documented problems include faulty accelerator pedals that could stick in the depressed position, door mechanisms that malfunction in cold weather, electrical system failures, and corrosion on the supposedly corrosion-resistant stainless steel body. The accelerator pedal issue alone triggered a recall of nearly 4,000 vehicles, representing roughly 10% of total deliveries at the time. Each recall cost manufacturers an average of $500 to $1,500 per vehicle in direct costs, not including warranty expenses and reputation damage. More damaging from a financial perspective is the impact on resale values. Early Cybertruck models are selling for 15 to 20% below MSRP in the used vehicle market, compared to traditional trucks that typically retain 70 to 80% of their value after 1 year. This depreciation directly impacts Tesla's ability to offer competitive lease programs and affects customer financing options. Quality problems also generate negative word-of-mouth marketing, which is particularly damaging in the truck market, where buyers rely heavily on peer recommendations and brand reputation. Factor 4, performance reality versus marketing claims. Real-world testing by automotive journalists and early owners revealed significant gaps between Tesla's marketed performance specifications and actual capability. The most critical discrepancy involves towing capacity and range. While Tesla advertises up to 340 miles of range for the Cybertruck, real-world testing shows range drops to 160 to 180 miles when towing near the maximum capacity. This performance degradation is more severe than that of comparable electric vehicles, and significantly worse than that of gas-powered trucks, which maintain relatively consistent fuel economy regardless of load. For commercial buyers, who represent 40 to 50% of truck purchases, this range limitation is essentially disqualifying. Fleet managers require predictable performance for route planning and operational efficiency. The Cybertruck's variable range makes it unsuitable for many commercial applications. Cold weather performance presents another challenge. In temperatures below 20 degrees Fahrenheit, the Cybertruck's range can drop by 30 to 40%, compared to 15 to 20% for gas-powered trucks. This limitation significantly impacts sales potential in northern US markets and Canada, which represent 35% of the North American truck market. Factor 5, competitive market evolution. Perhaps most significantly, Tesla's timeline delays, allowed competitors to establish strong positions in the electric truck market. When the Cybertruck was announced in 2019, Tesla faced virtually no electric truck competition. By 2025, the landscape had transformed completely. Ford's F-150 Lightning, launched in 2002, captured early market leadership with conventional styling, proven reliability, and competitive pricing starting at $49,995. General Motors' upcoming Silverado EV promises 400 miles of range at a starting price below $60,000. Rivian, despite its own challenges, has established a strong brand presence in the adventure-oriented truck segment. Most damaging to Tesla's market position, these competitors understood truck buyer psychology better than Tesla did. They offered familiar designs with electric powertrains rather than revolutionary styling that alienated traditional truck buyers. Market research consistently shows that truck buyers are among the most brand loyal and change-resistant segments in automotive. They prioritize functionality, reliability, and familiarity over innovation or technology. Tesla's approach, leading with radical design and cutting-edge features, succeeded in the luxury sedan market, but proved incompatible with truck buyer preferences. The Cybertruck's commercial struggles have created significant financial implications for Tesla that extend far beyond the product itself. From a direct revenue perspective, Tesla's Cybertruck sales of approximately 45,000 units through mid-2025 have generated roughly $3.5 to $4 billion in revenue, well below the $15 to $20 billion annually that analysts had projected. This shortfall represents a meaningful gap in Tesla's growth trajectory, particularly as the company faces slowing growth in its core Model 3 and Model Y segments. The opportunity cost may be even more significant. Tesla invested an estimated $5 to $7 billion in Cybertruck development, including new manufacturing facilities, custom production equipment, and research and development. These resources could have been deployed to expand Model 3 and Model Y production capacity, where Tesla has proven market success and unsatisfied demand in several international markets. Manufacturing efficiency presents another challenge. Tesla designed its Cybertruck production line expecting volumes of 200,000 to 250,000 units annually. Current production rates of approximately 40,000 to 50,000 units. Units mean the facility operates at roughly 20% capacity, creating substantial fixed cost burdens that impact per unit profitability. The financial markets have taken notice. While Tesla's stock price hasn't declined solely due to Cybertruck performance, several Wall Street analysts have reduced their price targets, citing concerns about the company's ability to accurately forecast market demand and execute product launches. More broadly, the Cybertruck situation highlights important dynamics in the automotive industry that investors and business leaders should understand. First, the pickup truck market operates fundamentally differently from other automotive segments. Truck buyers typically purchase vehicles for specific functional needs: work, towing, hauling, rather than lifestyle or status considerations. They're willing to pay premium prices for capability and reliability, but they're resistant to paying for features they perceive as unnecessary. This buyer psychology explains why luxury truck variants like Ford's F-150 Limited and Ram's 1500 Limited succeed despite prices exceeding $70,000, while the Cybertruck struggles at similar price points. Traditional luxury trucks offer enhanced comfort and convenience while maintaining familiar functionality. The Cybertruck asks buyers to adapt to entirely new interfaces and capabilities. Second, brand loyalty in the truck market is exceptionally strong. Ford, General Motors, and Ram have cultivated customer relationships spanning decades, often across multiple generations within families. These brands have established trust through consistent performance in demanding applications. Tesla, despite its success in other automotive segments, lacks this established trust among truck buyers. The company's reputation for innovation and technology, key advantages in the sedan and SUV markets, carries less weight among buyers who prioritize proven reliability over cutting-edge features. Third, the commercial vehicle market requires different go-to-market strategies than consumer vehicles. Fleet managers and business owners make purchasing decisions based on total cost of ownership, maintenance requirements, and operational predictability. They typically test vehicles extensively before making large-scale purchases and rely heavily on manufacturer support and service networks. Tesla's direct sales model and limited service infrastructure create challenges in the commercial market that don't exist in consumer sales. Traditional automakers offer extensive dealer networks, fleet support programs, and established relationships with commercial buyers that Tesla must build from scratch. The Cybertruck situation offers valuable lessons that extend far beyond the automotive industry and provide insights for investors, business leaders, and market analysts across sectors. Lesson 1: distinguishing between interest and intent. The massive pre-order numbers that generated such excitement in 2019 illustrate the critical difference between consumer interest and genuine purchase intent. Tesla's refundable $100 deposit created a low-barrier way for consumers to express curiosity without a meaningful financial commitment. This phenomenon appears regularly in technology and consumer products. Companies often misinterpret early enthusiasm measured through pre-orders, social media engagement, or survey responses as reliable indicators of market demand. However, the progression from interest to actual purchase involves numerous additional factors, including pricing, competitive alternatives, and real-world performance. Investors should be particularly skeptical of businesses that rely heavily on pre-order metrics to justify valuations or market projections. While pre-orders can indicate product-market fit, they don't guarantee commercial success. Lesson 2: the risks of aggressive public commitments. Tesla's public commitments to specific pricing and timeline targets created expectations that ultimately proved impossible to meet without significant compromises. CEO Elon Musk's announcement of a $39,900 starting price was specific enough to generate media coverage and consumer interest, but apparently not based on a detailed cost analysis. This dynamic creates what economists call commitment traps, where organizations become locked into public positions that limit their strategic flexibility. Once Tesla had publicly committed to specific pricing, any changes would be perceived as failures rather than normal business adjustments. Companies in rapidly evolving industries should be particularly cautious about making specific public commitments during early development phases. While such commitments can generate valuable publicity and investor interest, they also create downside risks if market conditions or development costs change. Lesson 3: market segmentation and brand transfer. Tesla's assumption that its brand strength in luxury electric vehicles would automatically transfer to the truck market proved incorrect. This highlights the importance of understanding how brand equity varies across different customer segments and use cases. Brand transfer is particularly challenging when moving between market segments with different buyer psychology, decision-making processes, and value priorities. Tesla's brand associations with innovation, technology, and environmental consciousness resonated strongly with luxury car buyers, but carried less weight among truck buyers, focused on functionality and reliability. Companies considering expansion into new market segments should invest heavily in understanding the distinct characteristics and preferences of new customer bases, rather than assuming existing brand equity will transfer directly. Lesson 4: execution risk in complex products. The Cybertruck's quality issues and performance gaps demonstrate how execution risks increase with product complexity and manufacturing innovation. Tesla's decision to use unconventional materials and manufacturing processes created multiple points of potential failure. While innovation can create competitive advantages, it also introduces execution risks that may not become apparent until full-scale production begins. Companies pursuing innovative product strategies should build additional time and resources into development timelines to account for these risks. From an investment perspective, businesses pursuing radical innovation should be evaluated not just on the potential upside of success, but on the probability and cost of execution failures. As of mid-2025, Tesla continues to produce and sell Cybertrucks, but at volumes significantly below initial projections. The company has effectively pivoted from positioning the Cybertruck as a mass-market product to marketing it as a premium lifestyle vehicle for affluent early adopters. This strategic shift acknowledges the reality that Tesla's execution challenges have fundamentally altered the original business case. Rather than competing for mainstream truck buyers, Tesla now targets consumers who value the Cybertruck's distinctive design and advanced technology features over traditional truck capabilities. From a financial perspective, this repositioning reduces the Cybertruck's contribution to Tesla's overall growth trajectory. The smaller addressable market means lower volume potential, which limits the product's ability to drive meaningful revenue growth for the company. However, the project isn't a complete financial loss. Tesla has gained valuable experience in advanced manufacturing techniques, materials science, and electric powertrain technology that may benefit future products. The company has also maintained its position as an innovation leader in the automotive industry, which supports its premium brand positioning across all product lines. The Cybertruck struggles have also highlighted Tesla's organizational strengths and weaknesses. The company demonstrated its ability to develop and manufacture genuinely innovative products, but also revealed limitations in market research, cost estimation, and quality control that could impact future product launches. Looking forward, Tesla faces important strategic decisions about the Cybertruck's role in its product portfolio. The company could continue current production levels and accept the product as a niche offering, invest additional resources to address quality and cost issues, or potentially discontinue the product to focus resources on more promising opportunities. Market analysts generally expect Tesla to continue Cybertruck production, but at modest volumes that don't significantly impact the company's overall financial performance. The product serves important marketing and brand positioning functions even if it doesn't achieve commercial success. For the broader electric vehicle industry, the Cybertruck's challenges provide valuable lessons about the importance of understanding customer needs and market dynamics when developing new products. The success of more conventional electric trucks from Ford and General Motors suggests that consumers prefer familiar designs with electric powertrains over radical styling innovations. The Tesla Cybertruck story represents one of the most instructive business cases of the past decade, demonstrating how even successful companies can misjudge markets when assumptions about customer behavior, competitive dynamics, and execution capabilities prove incorrect. For investors, the Cybertruck serves as a reminder that sustainable business success requires aligning innovation with market realities, not just capturing headlines and generating buzz. High pre-order numbers, media attention, and social media engagement don't necessarily translate to profitable business outcomes. For business leaders, the case highlights the importance of thorough market research, realistic cost estimation, and conservative public commitments during product development. The most innovative products can fail commercially if they don't meet basic customer needs for quality, reliability, and value. Most importantly, the Cybertruck demonstrates that execution matters as much as innovation in determining business success. Tesla's ability to envision and develop a genuinely innovative product wasn't sufficient to overcome challenges in manufacturing, quality control, and market positioning. The question moving forward isn't whether Tesla can build impressive electric vehicles. The company has proven that capability repeatedly. The question is whether Tesla can consistently translate innovation into profitable business results while managing the execution risks that come with pushing technological boundaries. For now, the Cybertruck remains an expensive lesson in the difference between revolutionary products and revolutionary business success. See you in the next video.